Good morning, everybody, and welcome to today's Reverse Mortgages. This is not a credit class. This is a webinar, so you don't have to be on the video feed, but we really appreciate it. You know what it's like for the speaker talking to a blank screen? It's like murder. It's terrible. It's very painful. All right, so I'm Cindy Bishop with Cindy Bishop Worldwide, for those of you who don't know that, and I'm going to introduce our master instructor, Kelly Katalinas, today. For those of you that don't know Kelly, she's been in the mortgage loan business for over 30 years. See, we're getting older, so we just say over 30 years now. During that time, she's become a consistently successful lender and branch manager, leading her teams to success. She's also a very effective trainer for us, for agents. So if you ever see things that are advertised, they're always free when it's business building. So make sure you attend it. I don't just put stuff up there to blow smoke up people's pants legs. I'm telling you what, it's good stuff. So you should really be attending that stuff. With Kelly's educational approach and exemplary business reputation, she has earned awards like Best Lender Professional by the Washingtonian Magazine, among other like awards she receives for her excellence on an annual basis. Kelly is loved by her clients and agents, which is proven in the fact that more than 95% of her business is referrals. Kelly comes to us today with the topic of reverse mortgages, which all of us should be paying close attention to. I myself am thinking about doing this. So yeah, so take it away, Kelly.
Thank you, Cindy. I appreciate the kind words, and welcome everybody to Reverse Mortgage Loans. I have to tell you, this is a revolutionary loan program. There is a good reason to turn 62, regardless of what anybody says. And I really kind of want to walk you through this. This presentation, as opposed to some other presentations we presented on reverse mortgage loans, we're more kind of, how does a real estate agent use a reverse mortgage loan for a home purchase scenario? Well, there's more to this product than that. So we're going to touch on that, but I really want you to have an understanding of how strategic this program can be to anyone, as well as in the home purchase game. So we're going to go through it. Please use the chat for questions. Cindy will monitor. I will try to monitor and answer them as they come in, and we'll get started. So hang on, there we go. So what we're going to talk about today, we're going to just introduce the topic of reverse mortgages, and we really want to classify it as a retirement mortgage, okay? I know reverse kind of has a negative connotation to it, but I really believe it can be a very strategic program for those looking to retire. We're going to talk about the loan qualifications and options, how to use the reverse mortgage. There are several ways you can use it, several opportunities for it, the loan maturity, and why fairway. So here we go. So what's your opinion of reverse mortgages, right? Everybody's going to say they're great, or I've heard some bad things about them and I really want to know the facts, right? This is not the product that you may have first been introduced to 10 or more years ago, where there was a lot of kind of wild connotations about it. There's a lot of protections in this program. It is an FHA insured program, and everything is done through the federal government with the terms of that mortgage insurance piece. So if you're 62 or older, are you concerned about market volatility and inflation, outliving your savings, right? People are living longer. What you thought you needed in retirement 10 years ago may have shifted, okay? So, and with inflation, you need more, right? So a lot of people are concerned about outliving their savings. Making monthly mortgage payments in retirement, right? You're going to move away from earned income to retirement income. What do those mortgage payments look like? And not being able to continue to live in your home in a safe, sustainable way. So more and more and more, and you're seeing this as real estate professionals, people do want to age in place. People do want to make changes to their properties to age in place. You see families merging together in perhaps a family home, and children and their families are coming to live with a parent, right? So there's a lot of things here that a reverse mortgage can help achieve. So what is a reverse mortgage loan, right? It's exclusively for older adults aged 62 or older. It converts a percentage of the equity in the home into tax-free cash. So it doesn't mean it's free money, right? It's a negatively amortizing loan. You're just getting the cash each month and not being taxed on it, if that's how you choose to take it. There are no required monthly principal and interest mortgage payments on the loan. Okay, you don't have to make the monthly payment on this. You can defer that to a later point or not make it at all. And you do have to continue paying the associated property charges like real estate taxes and insurance. Okay, it does not have an escrow account. Okay, so those charges are handled outside and by the homeowner. So what is a home equity conversion mortgage, or a HECM? We're going to refer to it throughout the presentation as a HECM. Okay. We launched it in 1989. It includes a lot of amendments and many more consumer protections than when it first launched. It is the most used reverse mortgage in the United States. This is the program. It's the only reverse mortgage that is insured by the Federal Housing Authority. And again, it's exclusively for those that are 62 and older. So aren't reverse mortgages just a loan of last resort? That's the connotation that reverse mortgages have gotten over the years. People get into a situation where they need money, healthcare may have declined, it's more expensive to live than what perhaps pensions are supplying for, or assisted living or things like that, meaning a nurse comes into the home or something like that. So the primary reasons to get a reverse mortgage are first need, right? You need to address an urgent need like paying for in-home care. Lifestyle enhancement. A lot of people want to use a reverse mortgage to pay for things that are not in the standard budget that is afforded with your monthly pension. So maybe you like to travel. Maybe you like, to do things with your family. You want to use the reverse mortgage to buy a car, like you would an equity line, only you're going to use it on a reverse mortgage and have no monthly payments, right? So there's a lot of different things that you can use it for. Financial planning, to me, when I became certified to do a reverse mortgage program, this was the one that attracted me the most. Financial planning, using your home and thinking of your home differently instead of the place you just happen to live, but more as a financial tool. And I'm really going to stress a lot of that as we go through this. You can maximize cash flow, reduce taxes, and minimize risks. Again, just to restate, we are not tax advisors. We're just going to show you potentials through this. And obviously you want to seek a tax advisor's advice. So pros and cons of the reverse mortgage. So pros, let's talk about those. It's a source of cash flow. As baby boomers start aging out and approaching age 62 or older, there are a lot of properties in the United States with a lot of equity. Okay, you've got millionaires in the United States because they own property in high cost areas with a lot of equity that's just sitting there. Okay, they're not tapping into it. It's a nest egg for them. Like, oh, should anything happen, I can just sell my house and get some money. Well, this approaches it a different way. So the equity is a source of cash flow. There's no monthly mortgage payments. You can make the mortgage payments if you want, but you're not required to. So this very specifically for loan officers, for real estate agents, for self-employed people where you may have volatility in your earnings, this may work very, very well for you, okay? You still have to pay the taxes and insurance to maintain the home, which you'd have to do that anyway. And it's a non-recourse loan. The cons are there's a minimum age requirement. You have to be age 62 or older to even be eligible for it, okay? There are interest and fees associated with a reverse mortgage that does chip away at the home equity. It is a reverse, okay? You started out at 100,000 and you had it for 15 years, it's going to be a lot higher than 100,000 when you go to sell the property. But that's because you've taken money out, there's interest that compounds, and it gets added to the balance of the loan. It's negatively amortizing.
Hey, Kelly,
And yeah,
I'm sure you explain a little bit more about what a non-recourse is versus a recourse.
sure. So non-recourse loan means that you can sell the property and there's no penalty, meaning let's say that at the time the last homeowner passes away, okay, the heirs don't want the home. And let's say that what's owed on the home is 300,000, but the home is only worth 250 based on a new appraisal, right? You can let go of the property. You can just walk away from the property. There's no impact to the heirs. It's just non-recourse. That mortgage insurance component of the program takes care of that delta of what's owed. Okay, so the heirs are not on the hook for anything on the loan. They just have to make a decision on if they want the property or they don't in that situation. So no one's coming after anybody for that delta is the point. So reverse mortgage myths debunked. So the first myth, the bank will own my home. Well, no, you remain entitled on the loan for as long as you meet the loan terms, right? As long as you continue to pay your taxes and insurance and you live in the house, you remain on title, you are the owner, okay? The bank doesn't own the home. The next myth, I must own my home free and clear to qualify for a reverse mortgage. Not true. If you have sufficient equity in the home, you can pay off any existing mortgage at closing using the loan proceeds, okay? So everything with respect to how much of the loan you can take on your home in a reverse situation depends on your age, okay? And the value of the home and what the mortgage remaining is, okay? Typically, we're gonna get into some charts, but typically, if you're age 62, you can take about 40% of a loan. So it's about 60% equity has to remain, you can take about 40%. But if you're age 62 and you owe nothing on your home and your property's worth $1 million, you might be eligible for a reverse mortgage up to 400. Okay, just as kind of a ballpark. My heirs will be stuck with a big bill. No, you or your heirs will never owe more than the value of the home after the loan matures and the home is sold. Okay. So let's talk about the buckets of wealth. And we're going to look at 3 different sides here in the views, right? So when you're 18 to 62 years of age, this is your pre-retirement wallet, okay? The first 2 are going to look pretty similar as we go through the sides. So the first bucket is your monthly income, right? These are your wages, your commissions, your earnings, your pensions, your Social Security. This is what you get every month that you're trying to budget your expenses from, okay? The next one is your nest egg, right? This is 5 to 20% saved for retirement. Could be your 401ks, your stocks, your bonds, your lump sum savings, life insurance, IRAs, etc. Right? This is what you worked to achieve in the traditional sense that you're going to use for taking care of yourself in your retirement. Okay. And the last is your home equity, right? How much is your mortgage versus your home worth today? What does that look like, right? Your home, the real estate equity, this takes into account obviously down payments, monthly payments, maintenance, etc. So what do we have in terms of the equity in the property? When we look at traditional thinking and we talk about a retirement cash flow strategy, this is the way people mostly looked at it, right? To this point, before reverse mortgages came into play, You had your monthly income. Well, when you start retiring at 62 years of age, that earned income might decrease, right? If you're not actively working, you'd have to have a lot of investments perhaps to make up what you would have been making in your wages, commissions, business earnings, et cetera, right? So earned income decreases. Your supplemental income, if you planned in the traditional sense, is coming from that nest egg, right? You're going to filter out monies from 401ks, stocks or bonds, lump sum savings, and you're going to augment that monthly pension if you need it. That's what you planned for. That's the traditional thinking. And when you go to bucket 3, home equity, it's just sitting there. You haven't tapped into it for anything. It's just sitting there. You're in your home. It's increasing in value, and that money is not working for you. Okay. So with reverse mortgage, you've got to change your mindset in how you're using the home equity in your home. The new thinking is, what could we do with this retirement cash flow strategy, right? You're now 62 years or older. You still have that first bucket. It doesn't look any different. Your earned income is decreasing in retirement. Your second bucket, you still have that supplemental income. Nobody's touching that. That's still there. You still can get at it in your nest egg if you need to pull some money out of it to augment your monthly expenditures or whatever you have planned in your retirement. But now in a reverse mortgage, you're using your home equity. You're leveraging that equity with no monthly mortgage payments on the loan that you take. You're getting tax-free cash flow because it's not income. You're just taking the equity out of your house. It's not income. And it can be your buffer asset, right? So we're going to get into a few things here, but just think about that for a second. And so this is Wade Pfau, and he does a lot of talks on reverse mortgages. And used strategically, a reverse mortgage can greatly improve the sustainability of your retirement income, right? So let's think about, just for today, hypothetically, we all know the impact of inflation, right? Our dollar is not worth the same thing that it was. Maybe your stock and bond accounts have declined over the last year and a half, right? But you've been tapping into it because you need it, or a loved one needs it to help offset some of the expenses that they need each month, but it's valued less now, right? What you could have done perhaps is taken out a reverse mortgage, okay, pulled from the reverse mortgage, not touched those stock and bond accounts that have taken a hit already, because you want to leave them back in there when the market swings back around and they get more value. So maybe you pull money out of the reverse mortgage, augment your monthly living expenses and needs. And let's say 12 months from now, your stock accounts have grown and they've achieved great gains. Well, then take the gain at that time and pay down the payments on the reverse mortgage. See what I'm talking about here? You can use a reverse mortgage very strategically, okay, to buy time instead of going into savings and things in your portfolio that right now might not be advantageous to pull out. So when you think of this as a tool like that, and I'm going to use a real estate agent I know as an example, who took out a reverse mortgage. He said, Kelly, my commissions are all over the place. I never know what the year's going to bring. So what I did was I took out a reverse mortgage. I use it every month as I need it. At the end of the year, I evaluate where I am with my commissions and my earnings, and I pay it down if I choose to do that. If I don't, I don't. But that is how he operates. He uses it in such a way that he can manage how much he really wants on that loan and how much he really needs in terms of monthly income to live. Okay, so really strategic thinking. So with that, I just kind of want to talk a little bit about the loan qualifications and options, just so you have a general understanding of this.
Kelly, can I ask 2 questions before you?
Yeah.
Okay. First of all, can the homeowner sell the property with a loan.
Sure.
Okay.
Sure.
Is there
You're
help?
entitled, you sell it just like anything else. It's a loan just like anything else. You are the homeowner.
And then how long does the property need to have been one's primary residence?
It has to be your current primary residence. So it's not like it was your primary, you moved it out and rented it. You need to be living there
Or
as your primary
you can
residence.
use it as a purchase though, for your primary residence. as well.
Correct.
Yeah.
Correct.
How long do you, I mean, like, if you move in today, I mean, how long do you have to have been occupying it?
You can only keep the reverse mortgage for as long as you are living there. Once you vacate the property, that note is due and payable.
Yeah, but in answer to his question, you can buy a home with it,
Correct.
then move in.
Correct.
Yeah.
Correct. Absolutely. Does that make sense? Did I answer that question
I
properly?
mean, you guys should be
Well,
advertising the daylights out of this and helping people 62 and older buy their next home and with this loan that they're going to live in.
Well, it's also
Yes.
I was also wondering, let's say I have a rental property, or somebody has a rental property. If who knows, let's say they have 5 rental properties. I don't know about that. But they don't want to sell the house they're living in right now for whatever reason, but they have a rental property they want to maybe get a loan. Maybe it doesn't make any sense, but somebody else is going to ask. So do you have to move into that house or have it declared your official primary
Yes.
residence? And for how long? Like tax code, it has to be 2 years or something.
Think of this, it's an FHA loan. It's a primary residence. The borrower has to maintain it as their primary residence.
For how
When they
long? Like
move
1
out
month,
of
1
it,
day,
it's
or-
not a question of how long. When they move out of it and it's no longer their primary, the note is due and payable.
What if they don't live there today and they want to take advantage of this for some reason?
They need to move into it
And how long do they need to live there
as long as they have the reverse mortgage on it.
to apply for the loan? Could be a stupid question, but I don't think so.
No, it's not a question of how long they need to
It's like the
live
tax code. I
there.
mean, you have to live someplace for 2 years, I think, for, tax credits.
Kevin, this one doesn't qualify for that. If
No,
you do
no,
have a reverse
no.
mortgage, the
No.
minute you're not going to live there is the minute
Right.
you're selling it. You're
Right.
not, it's not, forget about the tax code.
I know, I'm not,
Right.
I just meant as an example. So I don't even actually have to live there
Yeah.
to get this loan. I could just say I live there, and, or I could say, today
No,
I
that's
live there.
fraud.
I know, that's what I want to find out. What is the
Yeah,
rule?
you
There's a
can't do
rule,
that.
there's
That
somewhere
is
there's a
fraud.
rule.
That's exactly right.
What's the
Can't do
rule? I
that.
mean, is it 1 day or 1 month or 1
No,
year?
you
No,
can't
it's
do that.
It's
permanently. It doesn't work
basically,
like that.
it doesn't work like that. It's for the life of the loan. Okay. So in
Yeah,
other words, you can't-
it's your forever home.
it's not like
Think
any
of it
other
that way.
loan. It's yeah, it is. They are serious about it too, because they send
Yeah.
out people
But
to check.
All right, I meant, just because it's being recorded, what I was
I
wondering
should-
was, how long do you have to have lived there as your primary before you can apply for this? Not to get all,
Oh,
No, so
2
think about,
seconds.
yeah, so you might have people that do have several properties and they're downsizing. They have their big house, they have a rental property, they're gonna move into the rental property. You need to make an argument for that so that we believe it to be true, that will be your primary residence, right?
so
What
there's
do
no
your
rule.
bank statements say? What does your driver's license say? What does your tax return say? If that hasn't happened yet, okay, it's a little harder to prove. But if it's happened and we see the documentation trail that now is, where your primary residence is, then we look at it like a primary residence.
Okay.
I think the answer to his question, which you said earlier, was that one, you have to have enough equity to apply for 60% of your equity to do the reverse.
Well, we run everything through. So it depends on the age of the borrower, of the youngest borrower, and the equity in the home, right? It's not going to be available on every home, depending upon the equity position or the ages of the borrower, et cetera. But we would run that scenario out to see if it was available. Mhm.
Like Kelly told me, probably at 62 and a half.
Right.
I'd probably only be able to get, and we're making this up,
Right.
30%. That's it. Now, if I wait 5 years, my percentage would be higher. Okay.
Right.
Because what they're doing, it's like anything. It's like Social Security. You get more as you get older.
Right,
because you
and then
have less
as,
time to live.
and then as interest rates get lower, you also get more. You know, so the interest rate plays into that as well. Yep. But who
My-
qualifies, obviously, I'm sorry, was someone else have a question?
Yeah, I had a question. My question was, if you had a HELOC on the property and you wanted to convert it to reverse mortgage, then that HELOC is paid off and then you just have the reverse mortgage, correct?
Correct,
Okay,
correct. As long as you have the equity position to do that, absolutely.
right,
Mhm.
okay.
So
Yeah.
is the 40% a sliding scale depending upon age?
Yes,
And 40% is the maximum?
no. No, it's not the maximum. It slides higher as you are older. Okay,
Okay,
so I'm using 40 as the conservative kind of view. But like if you're 90 years of age, you're gonna have more based on the age scales.
and the amount that would be available with the 40 or whatever it is grows as market value of the property grows?
Correct. So the equity line does grow along with the increased value in the property. So it compounds as the equity compounds, right?
And who determines this? How do they do appraisals? They do desk appraisals? How does the mortgage company decide that you're now eligible for this bucket of money versus a former bucket of money?
So it's not typically done that way. So there's a minimum amount of growth typically that will happen regardless of the market, okay, that they set. If you're
Okay.
trying to
Because
go
of
back,
age, because of age.
correct.
But
So
now
if
we're
you're trying
talking
to go
about market
back-
value.
Right, then you would reach out to the lender and see if a different evaluation can be done, because they're not automatically going to just say, oh, now you get this much more. Okay, there's a compounding and a minimum that takes place based on those factors.
And that is going to happen without refinancing.
So the equity line is going to grow without refinancing, yes.
That's fantastic.
Yes.
And on the flip side of that, though, can it decrease?
Well, if you pay against it,
Okay.
right, they're not going to limit it. They're not going to take it away from you if they had already established it. Okay. So it's not going to say like, oh, you can't get it now.
Mhm.
Right. But you also remember you can pay against it. And then that adds back to the availability again, you know, depending upon how you want to use this.
Well, that makes sense. It's just,
Mhm.
to me, it's kind of gray on how that, if things appreciate,
Mhm.
how that's going to all of a sudden magically appear as an asset. You know what I mean?
Yeah. The way it's more than I want to get into right here.
That's really in the weeds. I know.
Yeah.
But I never knew that. That's
Yeah,
very,
but there is a minimum that it will grow each year. Let's just put it that way. Who qualifies, again, must be 62 or older, has to be the homeowner. They have to own the property outright or have significant equity. Must use the home as a primary residence and must meet minimum credit and income requirements.
May I ask a question before you
Yeah.
go on? On that last slide, you had must be a homeowner as a bullet point.
Mhm.
So what happens if, let's say, for example, and I remember a couple like this, when reverse mortgages first came out, what happens if the spouse is not on the mortgage?
It has a spouse protection in
Oh, it
here. If
does?
the spouse wants to remain in the property, yeah. So
Oh,
there are
okay.
there's a non-borrowing spouse provision that's in there. And we're gonna go over a couple of things on that, yeah. So it's better than it used to be.
Oh, great,
with
thank
that.
you.
Yeah, so the eligible property types are single-family homes, 2 to 4 unit properties, as long as the borrower occupies one of them. Townhomes, condominiums must be FHA approved. Okay. Condominiums that qualify for a single unit approval. So there is a procedure if you run into a condo that may have had an expired FHA approval and the condo association didn't take up the reins to get it FHA approved again, there may be an opportunity to do a single unit approval for the reverse. Planned unit developments, townhomes, single family PUDs, GPUDs, modular homes, and manufactured homes that meet FHA requirements.
If this property that you're going to do a reverse mortgage on is a VA loaned property, and you're saying the reverse is an FHA, so
Yes.
how is that affected?
We have to see if we can, if it's a condo, we have to see,
If it's a single family home, not a
doesn't
condo.
matter. If it's a single
Does
family,
it then become does it then become an FHA loan, or does
yes,
it? So you lose the VA.
yes.
Okay.
Yep. So how much equity do I need? So again, rough figures. You roughly need at least 50% of the home equity to qualify for a reverse mortgage. In this example, you've got 400 home value, you owe 100 on it. The home equity is 300,000. So 75% of market value. And again, the borrower can bring funds to closing if there was a shortfall in the home equity, right? Someone really wanted a home equity, but the numbers didn't gel exactly. They feel the product might be worth it. They go into their savings and they make up the shortfall in order to put the home equity program on their house. So that is acceptable in this program. So how can I take my proceeds, right? If I want this reverse mortgage set up, what could I do with it once I have it set up? Well, you could do a single disbursement lump sum, right? You want all the money at once. You could do fixed monthly advances. You could use it as a line of credit, meaning you don't touch it until you need it, right? You just set it up. You just want it as a fail safe, and you can draw on it as you want, or you could do a little bit of both, right? You can do both monthly advances and use it as a line of credit. So for example, and I've said this story previous trainings, my mother, when my father passed, we did a reverse mortgage on my mother's home. Back, I want to say this was 2008. We decided that she wanted to put a new roof on the house. She wanted to do some upgrades to the house. And when we set up her reverse mortgage, she took, I want to say like 30,000 in a lump sum. And then we set it up as a stipend where she was going to take $1,500 a month for the next 15 years. Okay. So my mother is going to be 92 in August and has had the reverse mortgage since 2008. And, you know, like anybody who grew up in the Depression timetable, you know, she's worried about what she's leaving her children. Well, her children are 64, 59, and 55. She doesn't need to worry about what she's leaving her children, right? We want her to be able to live the life that she needs. So that was the way we set it up for her to augment Social Security and other pensions she receives, okay? At the time that she passes, we'll deal with what we need to do with the home. Either we take it over or we sell it. Okay. So how much money can I get with the reverse? Well, again, the amount of money you can get depends on the age of the youngest borrower or non-borrowing spouse, the interest rate you get on the loan. The lower the interest rate, the more you can get. The higher the interest rate, the less you can get. And the lesser of your home value or the HECM loan limit in our area, that's the high, you know, that's a high cost loan limit, 1,089,300. They don't define a high cost area on a HECM. That 1,089,300 is nationwide on a reverse. So huge advantage there. So here's the chart that we were talking about. How much could we get, right? So let's look at this for the hypothetical example. To the left, the youngest borrower's age is 74. The expected rate is 5.5%, and the home value is 600,000. Okay, now PLF means principal limit factor. Okay, for selected ages and rates. So when you go over to the chart, you can see the borrower is age 74. You go down to 74. The interest rate expected is 5.5. So you have a 45.8% is what they could get of that home value of 600,000 or 274,800. So from the standpoint of a real estate agent, you have a borrower that wants to downsize into a more retirement-friendly home. They're sitting on a ton of equity. You're listing their home for sale. They're expected to net, let's say, 500,000 out of the home sale. Well, in their mind, their thought process was, I'm going to pay cash for this smaller home, right? I'm just going to pay cash. You could come to them and say, well, why would you pay cash and use all of your cash that way and land back into the same situation where all of the equity is once again, tied up in the property, when you could bring 275,000 for down payment, get a loan for 274,800 and hang on to that other 275,000 and do something else with it and not have a mortgage payment, right? Not have a mortgage payment. So could you invest that 275,000 in a different way to offset the negative amortization on this reverse mortgage? Absolutely, you could, right? With the right financial planner and financial planning tool, you're going to leverage your resources for the borrower and still not have them make the monthly mortgage payment. It's just a different way of thinking about your home as an asset. So it's a way to position yourself as a, let's say you're a senior certified realtor or you specialize in working with seniors, but you never considered this. Yes, the home still needs to be a primary residence always. So just kind of think about that as you're meeting with people. You know, we ran into a customer last fall, came up to me and he said, my mother-in-law owns a property in Burke. She has like $100,000 mortgage on it. It's probably valued at $800,000. In the next 24 months, we're going to move her and us to Myrtle Beach, South Carolina. We're going to build a house to accommodate her and us. And he was over 62 as well. And we want to see how a reverse mortgage could possibly work. And I said, well, she's living up here probably for the next couple of years. She could take out a reverse mortgage now on that home, get cash to help with the builder deposits on the property you're constructing in Myrtle Beach, right? For what you need for your options and every time you make a change. Then when you all are ready to move and she's going with you, you're going to evaluate who's in that house as borrowers. Whoever the lowest age borrower is the age that's going to be used in this chart. And you're going to set up a new mortgage on that house with no monthly payments. Okay, so there's a lot of things you can do here.
You're saying you're going to set up that new property doing a reverse mortgage.
Correct.
Okay.
Correct. It records just like any loan. It's the same as any loan going on there. The only thing that's different is that it's a different note. It's a HECM note that's different, but it's a mortgage like any other mortgage. It just happens not to require principal and interest payments on it.
How do the interest rates compare to a traditional FHA mortgage?
They're higher.
How much? How much?
They're higher. I would probably say 3/8 to 0.5%.
Okay.
On average. But there's no other product like this that affords this possibility.
So how do you get out of this reverse mortgage?
You can
Just like-
refinance it. You can
Oh,
refinance it to a traditional mortgage. You can sell the house and pay it off.
Okay,
Yep. You're still the owner. You can do whatever you want with it.
So if you have rental properties, you could pay down your mortgage as you sell off your rental properties.
Absolutely. So using it, so here's some advantage, right? The unused portion of the line of credit grows. It grows at the same compounding rate as the loan balance. Okay. Greater borrowing capacity over time. It's secure. It cannot be capped, frozen, or eliminated due to market conditions. So how many of you who had home equity line products on your properties over the last few years, banks have come out and said, you can't access it. We're stopping the access on it. If they were worried about home values or a, like a balloon effect that you were going to have a market correction, you could suddenly get that letter in the mail and says, you know what? Your equity line that was out there at 100,000 limit, we're capping it at 80,000 right now. You can no longer tap into that other 20,000. That cannot happen on a HECM. Okay. And it's liquid home equity, so you can borrow it, pay it back, borrow it again. You can keep doing it. And that's why I'm saying some people as a financial tool will look at what they have in their retirement savings accounts, speak to their financial planner and say, is there a better way?
So in a traditional, bank lending terms, you have a rolling line of credit.
Correct. Traditional bank, you have a line of credit, right? You have to pay it each month, right? If you don't pay it,
you can pay zero or whatever you want.
On this, you don't have to pay it.
Up to the maximum of the amount that can be borrowed.
Correct. So initially you'll have an amount. Okay. You'll have an amount you can borrow. That will grow over time. So you'll see on your statements how much access you'll have each month as that grows. And then if you pay against it, you'll see that reflected monthly. It'll change.
Let's say you hit the limit right away.
Mm-hmm.
And you don't intend to pay the monthly interest charges or things like that. Do you ever have a cash call?
No, only if you're not paying your property taxes and insurance.
Okay, all right.
Okay, so line of credit growth, to give you an idea, you have a 62-year-old borrower. The home value was worth 600. The available line of credit at the time was 223,506. Okay. Now that borrower is aged 89. The value of the home is now worth $1,024,000. The available line of credit is $1,026,643. So it's powerful, right?
Is that automatic or do you have to?
It's automatic.
Okay.
So common uses for the line of credit, you want to refinance your standard mortgage to eliminate monthly mortgage payments. So a lot of people, outside of using a reverse for the purchase of a home, they evaluate their own mortgage scenario. They might say, you know what, let me give you another example. And this is why I think it's really powerful. You've been planning your whole life to retire at 62. But guess what? They keep moving the needle on when you could receive full Social Security benefits, right? And maybe that's 67, maybe that's 70, right? That changes your view on your timing for when you had planned on retiring. And you're saying, well, do I pull Social Security at age 62 at a reduced amount, or do I somehow bite the bullet and handle my own expenses for the next 5 years to age 67 so I could get more when it's 67? Well, a reverse mortgage could be used in that scenario to cover that delta of time, right? that you could use that reverse mortgage to pay your insurance premiums, to pay you monthly, do whatever you need to do, not take your Social Security until such time as you want to, and still retire at 62. So you can think strategically here. Refinance your standard mortgage, eliminate your monthly mortgage payments. Again, you still have to pay your taxes and insurance. You can use the available line of credit as standby portfolio protection. This is what I'm talking about. You don't have to use the HECM at all. But if you're tapping into an asset when it's the worst time to liquidate an asset, you could use this instead.
When you have, when you're using the HECM, does that change your original monthly payment or not? Or is this an additional payment? If you choose to use, if you
So-
choose to have a payment, I'm sorry.
So think of it like a traditional line of credit. If you had a $50,000 line of credit, you have interest charges associated each month on $50,000.
Right,
If you now took 10,000 against that, you now have interest charges associated with 60,000. This is the same concept in reverse. You're going to have increased interest charges the more you use it, and that's going to compound every month. So then it's going to negatively amortize more because the balance has increased, but you still have no monthly payment on it.
so what has happened with your original? Does that go away? Do you still have that original monthly payment?
There's no original monthly payment. The payment's going to change every month based on where's the interest rate, because it's a line of credit, and how
Mhm.
much is owed on it each month. So think
Okay.
just like your credit card changes. This is going to
Okay.
work just like a credit card in reverse.
I think she's
Going to
thinking,
add
that-
to the balance.
I think she's thinking you could layer this as like a second mortgage, but this is always going to
It's
be a first
primary.
mortgage. and you're
Primary,
always
it's
going
not
to
a
have,
second. It's a
have the
primary
first,
mortgage.
that other mortgage paid off.
So that
Correct.
other mortgage
Basic.
goes away.
Correct. We are in first
Okay.
position. This is not a second position loan. Correct. Sorry, I misunderstood. Thank you. Common uses, increase your cash flow to close a retirement income gap, as we discussed. Get the most lifetime value from your Social Security benefits. Maybe you want to donate to charitable organizations. You can use it as a wealth multiplier to potentially pass a larger nest egg to the next generation. You know, some people use this and they want to gift money to their kids, you know, so that, okay, I'm going to put money in a college fund for each of my grandchildren, or for a wedding or something like that. You can pay for home renovations, in-home care, or other big ticket expenses, and long-term care insurance premiums. That's probably one of the biggest uses of this. People want to modify their current houses to make them age accessible so they can age in place, right? Maybe they're adding elevators. Maybe they're adding wider hallways, you know, handicap accessible bathrooms, wheelchair accessible, you know, walkways and hallways. A lot of things you can use this for. So, and this is pretty much it, right? If you look at home health care, the average cost is $59,488 for Alzheimer's care, meal prep, light housekeeping, errands. Assisted living facilities on average, $54,000 annually. And nursing home care, private, about $108,000 annually. So again, Medicaid only pays for shared rooms, and 95% of people have no long-term care insurance, and over 50% will need it. So you can close the gap with this. And again, as I said, I really see this as a financial planning tool. I think if you speak to your financial planner, your borrower speaks to their financial planner, you look at this as a tool. If someone's moving or wants to age in place, this is one way it can help them. It can help keep your adjusted income low, right? Because it's not income, yet you're getting it every month. Make your traditional retirement funds last longer. It's a hedge against market risk. And that's probably one of the biggest things that your financial planner is going to want to talk to you about. You can insure against longevity or pay for long-term care with it. And you can maximize other retirement contributions. You can incorporate this into the retirement income strategy. So why 62, not 82, right? Maybe the best time to secure a reverse mortgage. Why set this up sooner than later? Okay. Well, Sachs and Sachs coordinated strategy says, open a line of credit early. You have 78% cash flow survival rate in your retirement. You have a 4% post-tax initial withdrawal rate based on a 32-year investment return. Again, everything is typically based off of like, 95 to 100 years of age. Home equity, last resort, the conventional passive strategy. So let's say you delay the opening of the line of credit until your portfolio is depleted. Well, now your cash flow survival rate in your retirement falls to 60% versus 78%. And again, you still have that 4% post-tax initial withdrawal rate, okay? If you do nothing, you don't touch your home equity at all, you're assuming you're gonna take 4% post-tax initial withdrawal, ignore your home equity, your cash flow survival rate in your retirement is about 35%. So you can see how done strategically, you can really stretch your retirement earnings. You have to think about your house a little differently. It can't just be like, I'm so proud I paid it off into zero. I get to leave this to my kid. I'm not knocking that. That's the way my mother thought. I'm not saying that's not something to be proud of. I'm saying, what if you could do it differently? What if you could set up a nest egg for your children differently than relying on the equity in the home, and you can live a better life accordingly? Again, you could incorporate it into your retirement income strategy. If you open them early, but then delay its use for as long as possible, offered increasing success rates as more line of credit was available to be drawn down the line. So you could open the line of credit, never draw on it. It's still going to grow over time. You're still going to have more and more and more access to it as your home equity increases over time. Okay. And that's another strategy, just to have it set up, regardless of when you want to tap into it. It has the top consumer protections now. They've really modified the program. The borrower has to receive counseling from a HUD-approved agency, which we set up. There are initial disbursement limits on it. So you can't always get everything at once, depending upon the transaction. There's a financial assessment. We have to be sure the borrower has enough residual income for minimum sustainability, a lot like VA loans, where we have to do a residual income calculation to be sure they can meet minimum monthly obligations. The non-borrowing spouse protections, due and payable status may be deferred. So if you have a non-borrowing spouse and the borrowing spouse passes away, that due and payable clause that happens once that person is deceased may be deferred because the non-borrowing spouse might want to remain in the property. The line of credit is secure and any unused line of credit grows regardless of the home value. And again, it has that non-recourse feature that we talked about. Can it be used to buy a home? Absolutely. This is what we were talking about. We call that an H4P program, the HECM for Purchase program. Whether you want to upsize, downsize, or right size into your ideal home, you can move closer to your grandchildren. You can put as little as 45% to 65% of the purchase price down from your funds. So that's kind of the spread based on age and other factors as to what the down payment might look like. You can keep more of your retirement assets to use as you wish as compared to paying all cash, as we talked about. Again, there's no required monthly mortgage payments. Okay, there isn't another loan program that's like this. And you have to pay, again, the property charges. There are some things, and I'm just going to mention them here. There are proprietary reverse mortgages, meaning they are not FHA reverse mortgages. There are some banks out there that offer reverse mortgages in the conventional realm. They are proprietary, they are private, they house them in their own portfolios. They typically have to have a very high property value, meaning 1 million or higher. They live in a non-approved, an FHA non-approved condo complex. In other words, this is kind of like a product that fills that I can't get the condo FHA approved bucket, but they want to reverse. Sometimes they offer them to retirees younger than 62. Again, it's up to the bank that's offering the proprietary. And it might not have mortgage insurance premium, but it might have a much higher interest rate. Okay. And it might not have those protections that FHA puts in there in terms of it being a non-recourse loan and some strategies for the heirs to buy the property. Loan maturity, again, what causes the HECM to be due and payable? And I know we're close on time, so I'll talk quickly. The HECM is due and payable when you sell your home, when you transfer the title to someone else, the last surviving borrower moves out permanently, or you default, meaning you're not paying your taxes and your insurance, and the last surviving borrower passes away. How is the loan balance repaid? So the loan is not yet due and payable, meaning the borrower can pay as much or as little toward the loan balance each month as they wish, or they can make no monthly payments, but continue just to make the property charges like taxes and insurance. When a maturity event happens, the loan is due and payable, typically satisfied via the sale of the home. HECM loans are non-recourse loans, meaning the sale of the home will always satisfy the loan repayment obligation. Neither the borrower or the heirs will be personally liable for any balance deficiency. That's what mortgage insurance is for. So people will say HECMs are expensive because of the private mortgage insurance. Well, that's why. House is worth 250, you owe 350, you sell the property, that 100,000 delta is not the responsibility of the owner. So the options for the heirs, it's really looking at the chart two ways. Do the heirs want to keep the home? Is there any equity left? In the top left, yes, there's equity left, and yes, the heirs want to keep the home. So they could pay off or refinance the loan balance. Or they can sell the home and pocket any profits. It's up to them, yes or no, right? If there's no equity left in the home, but the heirs still want it, they can purchase the home with a short payoff based on 95% of the new appraised value of the home. So in our example, if the house was worth 250,000 and they owed 350 on the note, the heirs could still purchase the property for 95% of the 250,000 value, or 237,500, and keep the house. Okay. And then lastly, if they don't want to keep the house and there's no equity left, they don't want to deal with it, they can't put it on the market and net anything out of it, none of them want it, they can sign the deed in lieu of foreclosure over to the bank and walk away. Okay.
You mentioned the mortgage insurance. How monthly, what is the premium for the mortgage insurance?
Yeah, so it's typically 0.5% and it'll roll.
Okay.
And again, just a little bit about Fairway. I'm coming to the end of this. We are one of the largest lenders in the country for reverse mortgages. Okay. We do a lot of them, and I really love talking about this program. I think there's a lot of misunderstandings about it. I think as you work with people in the senior communities, whether you have relatives, whether you have borrowers, you hear downsize, upsize, whatever, and they're in this age and availability and sitting on an asset, it's worth considering, and even bringing the financial planner and the family into it. The biggest objection is always the heirs, right? The heirs are afraid they're not going to get equity. They don't want mom and dad to use it this way. That was what they were looking forward to. You know, and maybe mom and dad want to spend their retirement, you know, enjoy themselves, but it is a family conversation and it takes some time.
I think it's a great thing. Kelly, I have another class starting.
Yep.
So we got to get going, but this was wonderful. And I have sent you the roster with everybody that attended. If
Okay.
you would please send the slides out to them, that would be great so that they have your contact information.
Sure.
They
Sure.
all
And thank
have
you so much. I
questions.
really appreciate all the
great.
questions.
This was the best reverse mortgage.
Thank you,
webinar
Kelly.
I've ever been on. Okay.
Thank you. My pleasure.
All
Thank you,
right.
Kelly.
Thanks a
Have a
lot,
good day.
everybody. Take care.
Take care.
Bye-bye.